Have you ever wondered what cryptocurrency really is? Maybe you've heard about Bitcoin, Ethereum, or the latest altcoins, but you're not quite sure how it all works. In today's video, I'm breaking it all down for you, from the basics of blockchain to how to invest smartly and avoid scams. By the end of this video, you'll not only understand crypto, but you'll know exactly how to start your journey with confidence. Welcome to Building Wealth Today TV. If you are one of the 500 or so that regularly watch this channel and have not yet subscribed, take a moment to do so now. Let's dive in. Think of cryptocurrency as digital money that runs on a public record book called the blockchain. The key difference is that it's decentralized, meaning it's not controlled by banks or governments. Instead, all transactions are recorded on that public blockchain, making the system transparent. And because it exists on the internet, it's global, allowing for faster and cheaper cross-border transfers. Bitcoin was the first and is still the most trusted cryptocurrency, created as a peer-to-peer electronic cash system. Its real-world uses include everyday payments, sending money to family abroad, and for some, a hedge against inflation in their local currency. To truly understand cryptocurrency, we need to look under the hood at the revolutionary technology that makes it all possible: blockchain. So, what is it? At its core, a blockchain is a special type of database, a digital ledger. But instead of being stored in one place, it's distributed across a vast network of computers. You can explain it as a chain of digital blocks. Think of each block as a page in this ledger. It contains a list of transactions, records of value being exchanged. Once a block is full, it's sealed with a unique digital fingerprint called a hash. This hash is then included in the next block, creating a cryptographic link. This is the chain part of blockchain. Each block is chained to the one before it, all the way back to the very first one, creating an unbroken, chronological, and verifiable history. A great analogy is to think of it like a special Google Doc. This document is shared not just with a few friends, but with thousands of people worldwide. Everyone has their own identical copy and can see every entry ever made. Now, imagine someone tries to go back and secretly change a detail, say, altering the amount on a past transaction. The moment they do, their copy of the document no longer matches everyone else's. The network of computers would instantly spot this discrepancy, like 1,000 proofreaders all shouting, "That's not right!" The fraudulent change is immediately rejected. This is what makes a blockchain immutable. Once a transaction is added to a block, and that block is added to the chain, it's permanent and cannot be altered. This creates a level of trust and transparency that's simply not possible with traditional centralized systems. So how does this global network agree on which transactions are valid and what to add to the chain? This is achieved through a consensus mechanism, a set of rules that governs the network. The original and most famous method is called proof of work, which is the engine that powers Bitcoin. In this system, powerful computers, known as miners, compete to solve an incredibly complex mathematical puzzle. This isn't a puzzle for human brains. It requires immense computational power, and miners all over the world are racing to find the solution first. This race is the work. It's intentionally difficult and energy-intensive because it secures the network. To cheat the system, a bad actor would need to control more than half of the entire network's computing power, a feat that is practically and financially impossible. The first miner to solve the puzzle earns the right to add the next block of transactions to the chain. As a reward for their effort and the electricity they've spent, they receive a payment in newly created cryptocurrency. This is how new bitcoins are minted and enter circulation. While incredibly secure, proof of work's high energy consumption led to the development of a newer, more energy-efficient method: proof of stake. Think of it as an evolution. Instead of a race of computational power, It's more like a lottery where you have to put down a deposit to participate. In a proof-of-stake system, there are no miners. Instead, users called validators lock up, or stake, their own crypto as collateral. They are putting their own money on the line to vouch for the network's integrity. The network then uses a combination of factors, including the amount staked and a bit of randomness, to choose one validator to create the next block. The more crypto you stake, the higher your chance of being chosen. This system is secure because if a validator tries to approve a fraudulent transaction, they are punished by having a portion, or even all, of their staked collateral confiscated. It's a powerful financial incentive to act honestly. For their service, chosen validators are rewarded with transaction fees from the block they validate. A famous real-world example of this is Ethereum, the world's second-largest cryptocurrency. For years, Ethereum ran on proof-of-work, just like Bitcoin. But in September 2022, it underwent a historic upgrade known as the merge. In a monumental feat of engineering, developers transitioned the entire live network from proof-of-work to proof-of-stake. It was like changing the engine of a 747 while it was in mid-flight. The result was staggering. Ethereum's energy consumption was slashed by over 99.95% overnight. This single event drastically reduced the network's environmental footprint and set the stage for future upgrades to make it faster and more scalable. This evolution from mining to staking shows that blockchain isn't a static technology. It's a dynamic field constantly innovating to become more efficient, secure, and sustainable. Welcome to one of the most crucial steps in your crypto journey: setting up your own wallet. Think of this as the moment you graduate from being just a customer of a financial system to becoming your own bank. To hold and control your crypto, you need a wallet. Now, here's a common misconception. The wallet doesn't actually store the coins themselves. Your cryptocurrency exists as records on a global, decentralized database called the blockchain. Your wallet's true purpose is to securely store the cryptographic information, your private keys, that prove you are the owner of your funds on that blockchain. It's the only thing that gives you access. Without the key, the funds are inaccessible. With it, you have total control. This concept is called self-custody, and it's a cornerstone of the crypto world. It's incredibly empowering, but it also comes with great responsibility, which we'll guide you through right now. Broadly speaking, wallets come in two main flavors: hot and cold. Hot wallets are software connected to the internet. These can be mobile apps like Trust Wallet, desktop applications like Exodus, or browser extensions. Their biggest advantage is convenience. They are fantastic for frequent trading, daily transactions, and interacting with the world of decentralized applications, or DApps. Think of a hot wallet as the cash you carry in your physical wallet. It's for your everyday spending. Because they're online, they are more vulnerable to remote attacks, phishing, and malware. You wouldn't carry your life savings in your pocket, and the same logic applies here. On the other end of the spectrum, we have cold wallets. These are physical hardware devices, like a ledger or Trezor, that are kept completely offline. Their superpower is security. Your private keys are generated and stored on the device itself and never touch the internet, making them virtually immune to online hacking. A cold wallet is like your personal high-security vault. It's less convenient for quick transactions, but it's the gold standard for securely storing crypto you don't plan to touch for a long time. For most people, the best strategy is a combination of both: a hot wallet for a small amount of spending crypto and a cold wallet for your long-term investments. So, let's get you started. Popular, beginner-friendly hot wallets include MetaMask, which is the go-to for the Ethereum ecosystem, or the Coinbase wallet, which is great for newcomers. Setting one up is your first real, practical step into this world. The process is straightforward. You'll go to the official website or your phone's app store, and I must stress, only download from official sources to avoid malicious fakes. Once downloaded, you'll open the app and select the option to create a new wallet. The app will then guide you through the next, most critical phase of the setup. During setup, you will be given something called a seed phrase or recovery phrase, typically a list of 12 or 24 random words. This is the single most important piece of information you will receive. This phrase is the master key to your entire wallet. If your phone is lost, stolen, or broken, you can use this exact sequence of words to restore full access to your funds on any new device. Now, listen very carefully. You must write this phrase down and store it somewhere safe, offline. Never, ever store it digitally. Don't take a screenshot. Don't save it in a notes app, and don't email it to yourself. If a hacker gains access to your device or accounts, they will find it. And absolutely never, under any circumstances, share it with anyone. No support team, administrator, or developer will ever ask you for your seed phrase. Anyone who does is trying to steal your crypto. Losing this phrase is like losing the master key to a bank vault that only you have access to. No one can help you get back in. You are the bank, and this is your ultimate responsibility. Once your wallet is set up and your seed phrase is secured, you're ready to transact. To receive crypto, you'll use your public address. Think of this like your email address or bank account number. It's a long string of characters that is completely safe to share. People can only send funds this address. Now, how much should you start with? We strongly recommend you don't begin with a large sum. Your first transaction should be tiny, maybe just $10. The goal isn't profit, it's education. Send it from an exchange to your new wallet to get a feel for the process and see how transaction fees, or gas, work. Once you're comfortable, you might move up to $100. This is still learning money, but it allows you to explore swapping tokens or trying a simple application. Before you even consider investing $1,000 or more, you should have a cold wallet ready. That level of investment demands maximum security. Your process should be buy on an exchange, then immediately transfer it to your cold wallet for safekeeping. Practice sending a small amount back and forth. It might feel nerve-wracking at first, but this hands-on experience is the most valuable education you can get. When you're ready to invest, the most important rule is to start small and only invest what you're prepared to lose. Don't go all in. A smart strategy is dollar cost averaging. For example, investing $50 a week in Bitcoin for long-term wealth building, regardless of the price, averages out your cost over time. Stablecoins, which are pegged to a currency like the US dollar, are a good entry point to get comfortable with the ecosystem without the volatility. And a crucial warning about hype coins. If someone guarantees a 10x return overnight, run. Legitimate projects don't rely on such promises. Also, be aware that governments are catching up. Keep an eye on regulation, as it can impact the market. Welcome to the fast-paced world of crypto trading. To start, you'll need to use a cryptocurrency exchange. Think of popular platforms like Binance, Coinbase, or Kraken as the digital equivalent of the New York Stock Exchange, but for crypto. They are centralized marketplaces where buyers and sellers from all over the world come together to trade digital assets. Getting started is usually straightforward. You create an account, complete a security verification process, often called KYC or Know Your Customer, and then fund your account with fiat currency or other cryptos. These exchanges provide the charts, tools, and liquidity needed to execute trades almost instantly, making them the primary gateway for most people entering the trading arena. Once you're on an exchange, you'll be greeted by charts filled with what look like little colored rectangles. These are called candlesticks, and they are the language of the market. Each candle tells a story of the price movement over a specific time period, whether it's 1 minute, 1 hour, or 1 day. The main body shows the opening and closing price. If it's green, the price closed higher than it opened. If it's red, the price closed lower. The thin lines, called wicks or shadows, show the highest and lowest prices reached during that period. By learning to read these candles, you can start to understand the battle between buyers and sellers and get a visual sense of the market's momentum. But traders rarely rely on price alone. They use technical indicators to get more insight. Two of the most fundamental are moving averages and the relative strength index, or RSI. A moving average smooths out price data to show the underlying trend. For instance, if the price is consistently trading above the 50-day moving average, it suggests a healthy uptrend. Traders watch for events like a golden cross, where a shorter-term average crosses above a longer-term one, often seen as a bullish signal. The RSI, on the other hand, is a momentum indicator. It measures the speed and magnitude of price changes. A reading below 30 suggests an asset might be oversold and potentially undervalued, while a reading above 70 suggests it could be overbought and due for a price correction. Let's walk through a practical example. Imagine you see Ethereum's price drop, and its RSI on the daily chart falls to 25, deep in oversold territory. You might see this as a potential buying opportunity. Now, how much should you invest? If you're starting with just $10, you can buy $10 worth of Ethereum. This is a fantastic way to learn the mechanics with minimal risk. If you have $100, you could place a $100 trade. But with a larger portfolio, say $1,000, a wise strategy is to risk only 1 to 2% per trade. That means you'd only commit $10 or $20 to this idea. After buying, you would immediately set a stop-loss order to automatically sell if the price drops further, protecting you from big losses. You'd also set a take-profit order at a price where you predict the bounce might run out of steam, securing your gains automatically. However, and we cannot stress this enough, active trading is extremely risky and difficult. The example we gave was a perfect scenario, but in reality, indicators can give false signals, and trades often fail. The vast majority of new traders lose money. For this reason, we strongly recommend that beginners focus their energy and capital on long-term investing, like the dollar-cost averaging strategies we've discussed. Think of trading as a professional skill that takes hundreds of hours to learn. Before ever using real money, use the paper trading or demo account features offered by many exchanges. Practice your strategies, learn to manage your emotions, and see if you can be profitable with fake money first. Your long-term investments are your foundation for building wealth. Trading should be treated as a separate, high-risk specialization, pursued only with a small amount of capital that you are fully prepared to lose. The crypto world has risks. Key warning signs include unrealistic promises, guaranteed returns, and projects with anonymous teams. Watch out for rug pulls, where developers abandon a project and run with investors' money, and pump and dump schemes, where a group hypes a coin only to sell it off en masse. On-chain investigators like CoffeeZilla have exposed countless scams, and their work provides valuable lessons on what to watch out for. A famous quote to remember is, "In crypto, FOMO, fear of missing out, is your biggest enemy." It leads to impulsive, emotional decisions. The future of crypto will be shaped by regulation. Governments are reviewing stablecoins and even developing their own central bank digital currencies, or CBDCs. The possible next wave is tokenized assets, where things like real estate or stocks could be represented as tokens on a blockchain, making them easier to trade and own fractionally. As analyst Benjamin Cowan says, "Crypto is a marathon, not a sprint. Focus on cycles, not hype." This long-term perspective is key. Cryptocurrency can feel overwhelming, but when you break it down step by step, it's simply a new kind of money with incredible potential. Start small, stay informed, and most importantly, avoid the hype traps. Here's a simple example of how you can make a profit with cryptocurrency. Imagine you buy one Bitcoin when the price is $20,000. Later, the price rises to $25,000, and you decide to sell. Your profit is the difference, $5,000, minus any transaction fees. If you sell your Bitcoin for dollars, you receive your profit in cash. If you trade it for another cryptocurrency, your profit is in crypto. This is called buying low and selling high. Of course, prices can also go down, so it's important to do your research and never invest more than you can afford to lose. One last important note. In most countries, profits from cryptocurrency investing are taxable. This means you may need to report your gains or losses on your annual tax return, just like with stocks or other investments. Keep detailed records of your transactions, including dates, amounts, and what you bought or sold. Tax rules can vary, so always check your local regulations or consult a tax professional to stay compliant. If you found this helpful, make sure to like this video, share it with someone curious about crypto, and subscribe to Building Wealth Today TV for more deep dives on money, investing, and building your financial future. And in the comments, let me know. What's one thing you want me to cover in detail about crypto or any other financial topics?